Take beta. It's been 3 years, beta. You both are earning. And you, Ria, you also started with saving. Tell Neha something. She has zero savings and she has no investment at all. I keep telling her to start at least an FD. Put some money in FD.
No, auntie. FD is a very old concept now. In fact, people who do FD make a lot of mistake. And Neha, you should not do FD without knowing these points. And you should also know these points if you are planning to do an FD. So watch this video till the end and make sure to subscribe to our channel Freedom Money English and download the Freedom app.
Hi, I am Ria and today we will be discussing about common mistakes to avoid while doing an FD. Fixed deposits have been long favored investment option in India, offering safety and steady returns. And according to our data compiled by Bank Bazaar, on an average, Indians save around 4 crore 25 lakh in FD. In total, India currently has rupees 103 trillion saved across 24.23 million deposits. The data also shows that Indians love fixed deposits, and this trend continues even today, despite ups and downs of the interest rate in the past. It is seen that Indian senior citizens and risk-averse investors opt for FD. However, despite their simplicity, investors often make mistakes that can reduce their effectiveness of their FDs. Then what should we do? We should diversify our investment. If you are saving around 10,000 every month, then don't put the entire 10,000 in one FD. Diversify it in equity, stocks, mutual fund and FD bonds, etc. If you want to invest in equity, then there is a formula. Subtract your age by 100 and the number that you get is the percent of amount you should be investing in the equity. For example, if your age is 26, then subtract 26 from 100. The number, that is 74, is the percentage should be invested in equity. And the remaining 26% should be invested in either bonds or mutual funds, etc. Like that, you can diversify your investment. Now let's get back to our main topic, which is what are the common mistakes that we do while saving in FD. Number 1. Ignoring interest rate across banks. Not all banks offer the same interest rates on FDs. Interest rates can vary significantly between banks, and even a small difference can have a considerable impact on your returns, especially for large sums over a longer duration. Number 2. Overlooking premature withdrawal penalties. Life is unpredictable and sometimes you may need to withdraw your FD before the maturity period. Many investors overlook the penalties associated with premature withdrawals, which can erode the interest earned. It is essential to understand these penalties before committing your money in long-term FD. Number 3. Not considering the effect of inflation. FDs provide fixed returns, but inflation can erode the purchasing power of your money. If the inflation rate is higher than the interest rate on your FD, then the real value of your investment may diminish over time. To mitigate this, make sure you invest across different instruments that offer inflation-beating returns. Number 4. Choosing long-term FDs without flexibility. Locking an FD for a very long term without flexibility can be problematic if interest rates rise in the future. If you lock in a low interest rate for an extended period, you might miss out on higher returns available from new FDs when the rate increases. Therefore, consider shorter term FDs or those with options to reinvest at maturity to stay flexible with changing interest rates. Number 5. Ignoring the credibility of the bank. The safety of your FD is closely tied to the bank's financial health. While FDs are considered safe, they are only as secure as the institution holding them. It is critical to invest with reputable and financially stable banks. In India, deposits up to 5 lakh rupees are insured by the Deposit Insurance and Credit Guarantee Corporation. So, diversifying large deposit across different banks can also be a prudent move. Number 6. overlooking auto renewal policies. Many banks offer auto renewal of FDs upon maturity. While this might seem as convenient option, but it can be detrimental if the interest rates are lower at the time of renewal. It's better to review your investments option and decide whether to renew the FD or explore other avenues that might offer better returns. Number 7. Neglecting documentations and nominations. Proper documentation is very crucial for hassle-free investment and withdrawal process. Many investors neglect the nomination aspect, which can cause complications for heir in the events of investors' demise. Ensuring proper documentation and nomination can save time and prevent legal issues later. Number 8. Failing to diversify investment. While FDs are a secure investment option, putting all your money in one FD can limit your earning potential. It is important to diversify your portfolio to include other assets like mutual funds, equities, or real estates, which can offer higher returns and spread the risk. Fixed deposits are our cornerstones of safe investment strategies in India, but they require careful planning and consideration to maximize benefit. By avoiding these common mistakes, such as ignoring interest rates across banks, overlooking premature withdrawal penalties, and not considering tax implications, investors can enhance their return and ensure financial stability. Diversification, careful selection of banks, and awareness of documentation requirements are key to successful FD investment strategy. With these measures in place, FD can remain a reliable and effective component of your investment portfolio. That's all, folks. Hope you enjoyed the video, and do not forget to subscribe to our channel Freedom Money English and download the Freedom app. We'll see you in the next video. Till then, take care. Bye-bye.